We have One Liberty Properties. It's ticker OLP. And we are joined with the president and CEO, Patrick Callan, and also the senior vice president and CFO, David Kalish. Guys, how's it going? How's your day?
Good morning. Good morning, Brian. How are you today?
I'm doing awesome. Excited to be in the office. I work from home. I haven't been in the office in a while, and I love the energy here, and I love the atmosphere. I got beautiful Detroit behind me, so I'm excited. And I'm going to let you guys take it away.
Good morning, ladies and gentlemen. I'm Pat Callan, President and CEO of One Liberty Properties. David Kalish, our CFO, is on with me as well. Thanks for allowing us the opportunity to introduce One Liberty Properties to you folks. We are a net lease REIT that's been concentrated and focused on growing our industrial portfolio. We're currently yielding, our dividend yield is about 6%. We are kind of dyed-in-the-wool, disciplined real estate folks. We're not necessarily financial engineers. We typically focus on location, access, layout of not only land, but building, and the reusability of all of our buildings. We assume that sooner or later you're going to be releasing and repositioning assets if you own them for the long term. We do have a fairly disciplined track record. We do believe that real estate, commercial real estate, is a cyclical business, and we're very mindful of the cycles as they play out over time. Typically, net lease has been deemed a passive, almost check of the month club type business. We have found it much more active. I think COVID reminded us of just how active the real estate business can be, even the net lease business at that. We had a number of tenants, as you might imagine, that were requesting potential rent waivers and rent deferrals, and having to kind of sift through those suggestions and requests reminded us that having a legitimate real estate fundamental toolbox is essential to running any real estate portfolio, because you just never know what's going to happen. I never would have dreamed 2-3 years ago we'd been working our way through a pandemic, but sure enough, that's exactly what we had to do. Our management team is extremely experienced. We've gone through many cycles and learned a lot from that. I think I've applied a lot of what I've learned over 30 years in the real estate business to the last year or two with respect to COVID, and learned something from it. Our interests are typically aligned, maybe incrementally so, in that management owns 22% of the outstanding shares. So we're very much aligned with the shareholders. You can essentially co-invest with us. You can look at a lot of different REITs to invest in, but there aren't terribly many REITs where you can truly co-invest with the management team. Our group owns roughly 22% of the outstanding shares. So if you're looking for a group to co-invest with and ride out a 6% plus or minus dividend, One Liberty might be worth a shot. I'm going to move on to page 6 of our slide deck. Our overall portfolio is 122 assets. Current occupancy is about 97%. Over the last 8 to 10 years, it's hovered in the 97 to 99% occupancy level. So we've enjoyed a very high occupancy level. We think that is a result of picking the right real estate for the right reasons at the right rents. And I think time has bore that out. Moving on to page 7 is our portfolio detail. We currently have about 55% of our entire portfolio is attributed to industrial type assets. If you go back even through May of 19, we've acquired roughly 11 assets. They've all been industrial in nature, about 85 million. So historically, we've had a fairly high retail component. We have, over the last number of years, begun selling retail and buying industrial, so really transforming the portfolio. Again, currently it's a 55% industrial portfolio by contractual rent income. Moving on to page 8, if you will. Geographically, we're in 30 states with our 122 properties. We have heavy concentrations in South Carolina, where we have 7 assets. We have 8 assets in New York State. It's about 9% of our top line rental income. Texas represents about 7.8%, and New Jersey just about 7%, as is Pennsylvania. So our heavy concentrated states again are South Carolina, New York, Texas, New Jersey, and Pennsylvania. You roll that up, it's about 41%, about 40 properties out of the entire 122 portfolio asset we currently have. On to page 10 of our deck. I'll let David speak to this.
Good morning. Thank you very much for joining us. Page 10, you'll see that our market cap is about $637 million. As Pat mentioned before, our insider ownership is about 22%, which means you're co-investing with us. We're very conscious. We have a very involved and dedicated investment committee, all of whom would be affected with every property that we purchase. Our current annualized dividend is a little bit shy of 6%, 5.9%, based on the price, which it pretty much closed yesterday at the same price that it is here mentioned on August 11th, which is 5.9% at $1.80 per share. If you turn to page 12, there's a little chart on the current dividend. And again, it's $1.80 per share. It's grown in the last 4 or 5 years from a little bit less, $1.66. We've nudged up to $1.80. We've been consistent, and we've paid the $1.80 through the pandemic, and we're currently continuing to pay the $1.80. And again, at the 5.9 or 6%. If you turn to page 16, page 16 shows you the history of our occupancy. And as Pat mentioned, we're currently at 96.7%. We have this chart here to show that over the last 10 years, through many cycles, our underwriting has been very strict and consistent, and we've never fallen below approximately, I see the lowest is 2019 at 96.8%. So it's a credit to our underwriting and the way we pick real estate that we purchase. Turning to page 17 shows our rental growth. And as you can see, back in 2014, we had a gross rental income of a little bit shy of $60 million. Right now, we're hovering at around $82 million. There was a small dip in 2020, all related to selling some of the retail properties. As Pat mentioned, we do sell some retail properties, which we'll get into in a few minutes, and the pandemic. Currently, for the 6 months ended June 30th, 21, as you see in the upper left-hand corner, we're at about $41 million of gross rent income. I'm going to turn back to Pat on page 20.
Going on to page 20, you can see the dispositions we've made over the last almost, I call it 2 years. There has been a transformation of our portfolio. I think this slide shows there's a fairly obvious pattern of selling retail over the last number of years. I might want to highlight an asset we sold a couple of months ago, which would be a Whole Foods in West Hartford, Connecticut. That was an asset we purchased some years ago for roughly $20 million and sold it very recently for almost double that, $40 million. That was a strategic sale that we felt it was time to kind of harvest those gains and get out. And this kind of illustrates, if you look at this slide throughout, for the most part, we're selling retail and enhancing our industrial portfolio. And our industrial acquisitions really almost started going back in, I guess, 2006, where we bought 2 industrial buildings, one in Baltimore, another one in southern Maine. And at that point, we were, I would say, a hybrid with respect to retail and industrial. Starting around 2013, when we bought a number of assets just south of Charlotte, both industrial, we really kind of focused almost entirely on industrial assets and have been chasing industrial assets really in earnest since roughly middle of 2013. But as I mentioned before, the last 10, 11 deals over the last 2 years have been exclusively industrial. So we think industrial is a good place to play. It is an aggressively priced market. We think it's a good time to be relatively cautious and conservative. We are finding acquisition opportunities, but you have to evaluate many opportunities to not get involved with bidding wars and overpaying for industrial assets. There's a tremendous amount of liquidity and capital chasing industrial. So we really have to be very conscious of not getting into bidding wars. We are seeing in certain industrial assets having 30, 40, 50, 60 bids on a particular asset. Those tend to get bid up beyond the price of reason. So we try to avoid those types of events. We do have a pretty good feel for buying mismarketed assets as opposed to mainstream marketed assets and seizing on those opportunities immediately. A number of our industrial assets were a result of identifying assets that weren't necessarily widely marketed to 10, 20,000 potential investors, where the prices seem to get a little out of whack. I'll move on to page 25, which is a slide with respect to the Whole Foods disposition. So back in October of 2010, it's hard to believe that was over 11 years ago, we purchased a freestanding Whole Foods in West Hartford, Connecticut. It was part of this lifestyle center that was called Blueback Square that we were all familiar with. We just purchased the freestanding single tenant Whole Foods at roughly $20 million. It was a full-size Whole Foods, about 47,000 square feet. We, I guess back in 16, pulled out additional loan proceeds with a refinancing, which we typically often do. So we pulled out another almost $6 million in 2013, and ultimately sold that asset just recently for a hair more than about $40.5 million, which was a wonderful trade for us. And it speaks to kind of what we do. We identify assets. We finance them very conservatively at the property level. By doing that, by financing them conservatively, putting most of them, if not all of them, on an amortization schedule where you're paying principal back every year, that allowed us to pull out on a refinancing in 16, 6 years after we purchased it, an additional $5.8 million. We were able to redeploy that $5.5 million, almost $6 million, to incremental new acquisitions going forward. Again, that just kind of speaks to our relatively conservative financing and ability to source assets. This was a good trade for us, and felt it was an opportune time to sell at almost double what we paid. This produced a internal rate of return, an IRR, if you will, of just about 20%, which is an exceptional return in that asset. I guess kind of wrapping it up, summary, we really believe fundamentals matter. They always matter. We've seen overheated markets where some in the commercial real estate world start to overlook real estate fundamentals. And in times of more challenged climate, those fundamentals, if you overlook them, we think come back and very much work against you. We survived COVID very, very well, and had to fend off a couple of gratuitous tenants that were looking for rent relief. But having been doing this for 20, 30 years, we were able to push back on a lot of those requests that just weren't warranted or deemed appropriate. So we're pretty good at handling our portfolio. Many cycles have schooled us in the appropriate ways to deal with different types of tenants. We had tenants looking for rent relief the same week they were drawing down a few $1 billion on credit lines. So it's just, you have to really stay tuned to your tenants, the marketplace, the sub-market, what's going on in the micro world and the macro world. And I'll just leave it with insider ownership, alignment of interests. Having 22% ownership of the outstanding shares of One Liberty Properties really keeps us focused and aligned with current and prospective shareholders. So we think co-investing is something unique to One Liberty Properties. That about wraps up our presentation.
If there are any questions, questions.
I got a couple good questions for you. I think they're good questions. I kind of thought of them, so I'm gonna think they're good. But you guys were highlighting the dividend yield about 6% for real estate related investors. A dividend is very important. But I mean, how important do you guys think a good dividend yield for your investors are? And any plans? Can you tease any plans for the dividend moving forward? I've seen a couple users in our chat that were kind of asking about the dividend.
Okay, the dividend for us is very, very important. We watch it very, very carefully, and we were able to maintain it, as I mentioned, through COVID. The answer as far as where the dividend raising, what I do is every quarter, the board meets quarterly, and every quarter I prepare a very detailed schedule on the information relating to the availability and the dividend. I can't predict where the dividend is going to go, which would be inappropriate, but I can tell you that management and the investment committee, all of whom are available and at board meetings and investment committees, are very, very focused on the dividend.
Great.
Our dividend has been quite consistent over the past 5, 6, 7, 8 years. We've never missed a quarter, but I cannot make any predictions on the future.
Of course.
That does differentiate us is we have consistently, and I can't tell you for the future, but in the past, paid out 100% of our taxable income, including capital gains, whereas under REIT rules, you're only required to pay out 90%.
Gotcha. Okay. Good to know. And one more quick question here. I mean, I would imagine that industrial, there probably isn't a ton of flexibility with the actual real estate. So, I mean, how many of your tenants are currently reopening or getting ready to reopen? Is it few or is it a lot?
Yeah, I mean, our industrial tenants never really shut down, so to speak.
I figured, right?
During industrial, the industrial segment, I can't think of one of our industrial tenants. I mean, there were a couple of slowdowns, and that was more just product related, getting product
right
from overseas or just logistics.
Mm-hmm.
There was no relief. There was no rent relief required for the industrial tenants.
Right.
No, it was very immaterial.
That's what I figured.
Thank God our portfolio, and focusing on the industrial segment, which is 55% of the total portfolio, I mean, that weathered the storm just beautifully.
Mm-hmm.
I think we had, 1 or 2 phone calls.
Correct.
Even suggesting some help. And, we're very good at analyzing, property level and company level financials and understanding who legitimately needs assistance to get them through a difficult time. And we granted some. As opposed to the individuals, organizations that were just doing it almost for sport.
Right. Great answer. I think to wrap up there, sounds like you guys got a stable dividend. It sounds like a very large majority of your portfolio really wasn't affected by the pandemic. So, YouTube audience out there, if you're looking for a stable play here, I mean, One Liberty Property is probably a good idea. It's ticker OLP. We have Patrick Callan, President and CEO, and David Kalish, he's CFO. Thanks a lot for joining us, guys, and have a good rest of your day.
Thank you
for the
very
opportunity.
much.
Enjoy your week.
Awesome.